You're probably paying for things you forgot you even signed up for. Today, 33 dumb credit mistakes that snowball fast and wreck budgets. Like a 0% for 12 months deal that backcharges interest later. Or one missed autopay that quietly dings your score for months. Stay for number 33, because the last one is genuinely insane. Credit card travel points cost more than the free flight. A so-called free trip can start costing money at home. In the 2010s, premium cards surged from Chase and American Express. People chased bonuses, then carried balances while planning dream vacations. Interest charges arrived monthly, quietly outrunning the value of points. Airlines like Delta shifted awards, making popular routes suddenly pricier. Cardholders paid annual fees, then paid interest on top. The twist is simple: points don't cancel high APR. That free flight can be the most expensive seat you take. 2. The minimum payment myth turns $1,000 into years. The balance barely moves, even though you keep paying. Banks print the minimum payment in bold on every statement. In 2009, the Card Act pushed clearer payoff disclosures nationwide. Those charts showed how long tiny payments can drag on. A $1,000 balance can linger for years with steady interest. People feel responsible, yet the principal hardly shrinks each month. Late in the cycle, fatigue hits and one payment gets missed. Then fees stack on, and the math turns nastier. The myth isn't paying, it's thinking you are progressing. 3. Balance transfers can backfire with one late payment. One missed date can flip a calm plan into chaos. Around the 2010s, banks marketed long 0% transfer promos. Consumers moved debt, then celebrated and stopped watching details. A single late payment can cancel the promo in many contracts. Some issuers also trigger a penalty APR after that slip. Suddenly, new purchases, even groceries, start accruing expensive interest. The shock feels unfair, but the fine print was always there. People learn it when the next statement doubles unexpectedly. 0% works until your calendar quietly forgets you. 4. Closing your oldest card can drop your score fast. The score drops first, and the reason feels backward. Many people close student cards from banks like Bank of America. They wanted simplicity, so they cut the oldest account. Credit models like FICO reward long histories and older averages. When that old line closes, your average age can shrink. Utilization can rise too, because total available credit is smaller. A landlord runs credit, and suddenly the number looks worse. The surprise is that closing debt-free still changes the math. 5. Maxing one card can tank your score overnight. Your score can fall before you even get the package. Credit scoring watches utilization, the percent of limit you use. Even if you plan to pay, the statement captures that snapshot. People shopping for a car see lenders react within days. Dealers run credit, and the rate quote jumps higher. Nothing was delinquent, just a limit, suddenly looking strained. Then the buyer pays it off, but updates lag behind. It's a photo problem. Timing matters more than intentions. 6. Store cards at checkout, the sneaky credit score hit. You save 10%, then pay for it later. At Target, Kohl's, and other chains, cashiers pitch quick approvals. The application often triggers a hard inquiry on your credit report. Some shoppers get approved, then find a tiny credit limit. That small limit makes normal shopping look like high utilization. People notice right when they need financing for something bigger. The twist is the discount lasts minutes. The inquiry lasts longer. Checkout feels like a deal, but credit remembers the moment. 7. Co-signing a car loan, one missed payment, you pay. The phone call comes when the car isn't even yours. Co-signers often sign at dealers for family, partners, or friends. Auto lenders like Toyota Financial list both names on the contract. If the driver misses, the account reports delinquency for both. Repossession threats land in the co-signer's mailbox, not the driver's. Some relationships end, but the loan stays linked anyway. Collectors call, and your own credit plans get derailed. People assume co-signing is kindness, but it's shared liability. You didn't borrow the car, yet you borrowed the risk. 8. Payment due date drift. 1 day late counts as late. A day feels small until the system stamps it late. Credit cards set due dates, but weekends and holidays complicate timing. A payment made Sunday night can post Monday, after cutoff. Some banks treat the cutoff earlier than people assume. Then a late fee appears, and interest can start immediately. People swear they paid, and they did, just late. Customer service hears the same story every billing cycle. The sneaky part is drift, not forgetfulness or laziness. 9. Autopay failure, the silent late fee and score damage. Autopay is supposed to be boring, until it isn't. Banks run updates, apps glitch, and scheduled payments sometimes fail. During major outages at Wells Fargo, customers reported missed bill payments. The due date passes quietly because nobody is checking manually. A late fee hits first, then interest, then a warning letter. Fixing it can take calls, documents, and patient follow-ups. Meanwhile, the report shows a mark you never intended. The twist is automation needs supervision, like a teenager driving. 10. Paying the bill early, but to the wrong card. You think you paid, and the system disagrees anyway. People juggle multiple cards from Chase, Citi, and Capital One. One misclick sends money to a different account number. Sometimes it lands on a closed card, bouncing back days later. Meanwhile, the intended card stays unpaid, drifting toward delinquency. Customer service can't always move payments after they post. By the time you notice, the late fee already stuck. Then you scramble, paying twice, just to stop damage. The mistake isn't lateness, it's misdirection through similar dashboards. 11. Paying only the statement balance, not the promo balance. The bill says paid, yet interest shows up next month. Promotional plans often track separate balances inside one credit account. A payment may go to the wrong bucket by policy. Store financing, especially, can allocate payments in unexpected order. So the promo balance lingers, even when you paid plenty. Then the promo ends, and deferred interest can suddenly apply. The plot twist is two balances hiding behind one card. You paid, but you didn't pay the one that mattered. 12. Deferred interest promotions. $1 missed, interest explodes. The interest hits like it time traveled from months ago. Furniture stores love deferred interest deals through banks like Synchrony. They advertise no interest, but only if paid fully. The next statement can look like a punishment, not a bill. Shoppers in Florida and Texas complained after small final balances remained. Some thought autopay covered everything, but it covered the minimum. Then, the retroactive interest posts, and the shock becomes real. It's not late interest, it's stored interest finally released. 13. Credit limit decrease after one big purchase. You swipe confidently, then your limit shrinks behind you. Card issuers watch risk signals, especially during shaky economic moments. A sudden large purchase can trigger automated credit line reviews. Some American Express customers call it a financial review surprise. Others see Chase lower limits after balances rise too quickly. The notice arrives after the purchase, when reversal feels impossible. Then utilization jumps because the denominator just got smaller. It can happen even when payments are on time. 14. Pre-approved offers on approval and can still deny. The envelope screams yes, then the answer becomes no. Banks send firm offers under federal rules based on credit screens. But income checks, identity checks, and verification still happen later. In busy shopping seasons, issuers tighten and reject borderline applicants. People show up at Macy's or Best Buy expecting instant credit. A clerk runs it and the denial prints in seconds. Then embarrassment lands, right there under bright retail lights. The fine print never promised approval, just an invitation. Pre-approved is just marketing language, not a final decision. 15. Hard inquiry pileups from rate shopping the wrong way. You think you're comparing, but your report records a stampede. Car dealers often send applications to many lenders at once. Credit models may group some, but not every type counts equally. People visit 3 dealerships, each running credit like it's harmless. Then the report shows a cluster, and the score dips. A lender sees risk, even though you were just searching. The twist is, shopping slowly can look worse than shopping fast. Your timeline, not your intent, shapes how it reads. 16. Applying for a loan right before a big purchase. The mortgage looked ready, then a couch almost killed it. Underwriters recheck credit before closing, sometimes days before signatures. A buyer visits IKEA, opens financing, and adds a new inquiry. That changes debt ratios and can force last-minute paperwork. Lenders ask for explanations, statements, and sometimes updated approvals. Closing gets delayed, moving trucks get rescheduled, temp housing appears. The buyer didn't miss payments, but triggered new risk signals. The twist is, small purchases become big problems at the finish. 17. Letting a card close from inactivity without noticing. The bank closes it quietly, and your utilization jumps loudly. Issuers like Citi and Discover sometimes close accounts for inactivity. Your total available credit shrinks, raising utilization across other cards. People notice when a score app suddenly flags a drop. They try reopening, but many banks require a new application. Now you have a closed account and a fresh inquiry. The twist is doing, nothing can still change your credit profile. 18. Carrying a small balance for credit building. The myth costs money because interest never cheers for you. Some folks believe carrying $10 boosts their credit score. FICO has long said interest isn't part of scoring formulas. Yet people keep a balance, paying interest month after month. They feel strategic, like they're feeding the credit machine. Meanwhile, issuers happily collect because the customer chose to revolve. Then a surprise happens. Utilization rises when limits get lowered. The tiny balance becomes less tiny when life gets busy. Credit builds from on-time payments, not from donating interest. 19. Ignoring utilization until the day before a mortgage. The number looks fine today, then the lender sees yesterday. Credit card statements report balances on cycle dates, not pay dates. Someone pays down cards, but after the statement already closed. The mortgage broker pulls credit, and utilization still looks high. Rates are priced off that snapshot, not your bank receipt. Trying to fix it takes a full reporting cycle. Some borrowers ask for rapid rescoring, which isn't always available. Meanwhile, closing dates hover, and sellers get very nervous. The twist is credit moves on calendars, not feelings. 20. Skipping rent reporting that could build credit. Rent is your biggest bill, yet it often stays invisible. In the 2010s, programs like Rent Track and Experian Boost gained attention. Others skipped it, thinking it was gimmicky or risky. Later, they applied for loans with thin files and few trade lines. A mortgage officer asks for history, and rent isn't there. One checkbox could have turned routine rent into visible reliability. 21. Not checking statements for recurring fraud charges. A tiny charge is often the scout before the invasion. Card thieves test a dollar charge to see if it sticks. Many victims spot it months later, buried under subscriptions. By then, chargeback windows can be harder to use. Banks ask when you noticed, and the answer sounds terrible. Meanwhile, merchants keep charging because the card stayed active. The twist is, fraud loves small numbers because humans ignore them. Checking statements is boring, but it blocks the slow bleed. 22. Disputing everything and accidentally missing real payments. A dispute feels like pause, but the billing clock keeps running. People file disputes after a bad product, hotel, or airline mess. While the bank investigates, minimum payments are still required. Some stop paying, assuming the disputed amount freezes the account. Then late fees hit, and the account can become delinquent. The investigation may even side with you, but damage remains. Customer service explains two tracks: dispute and payment obligations. The twist is winning the dispute doesn't erase missed due dates. You can be right about the charge and wrong about timing. 23. Ignoring medical collections until they hit your reports. The bill arrives confusing, so people set it aside. An ER visit can generate separate bills from doctors and hospitals. Months later, a collection notice shows up from a billing company. By then, the original provider may no longer accept direct payment. In recent years, bureaus changed how some medical debt is handled. But older collections can still appear and spook lenders. People applying for apartments get rejected over a forgotten clinic bill. They swear it was insurance, but paperwork never finished. The twist is health paperwork can follow you into finance. 24. Debt settlement adds the tax bill nobody mentions. The debt shrinks, then the IRS shows up uninvited. Oh. Debt settlement firms negotiate balances down for people in deep trouble. When a creditor forgives debt, it can be treated as income. A Form 1099-C can arrive after the celebration ends. Suddenly there's a tax bill attached to the relief. Some people in Arizona and California learned it during filing season. They had less debt, yet owed taxes they didn't budget. The twist is, forgiveness is not always free money. Your balance fell, but your taxable income may have risen. 25. Credit repair scams that erase accurate late payments. Promises sound magical because credit feels like a black box. Some companies claim they can remove real late payments quickly. The FTC has sued firms for illegal or deceptive practices. They often take upfront fees, then send boilerplate dispute letters. Bureaus verify accuracy, and the negative mark stays put. Meanwhile, customers lose time and money, and sometimes miss real payments. In extreme cases, scammers tell clients to create new identities. That turns a credit problem into a legal problem fast. The twist is, real fixes are boring, so scams sell drama. 26. Mixing business and personal credit on the same cards. Your business feels separate, but the lender ties it together. Many small business cards require personal guarantees from the owner. Then a personal loan application gets reviewed, and the story leaks. Banks see heavy spending and assume financial stress behind it. Some founders in Austin and Miami learned it during expansion. Separating cards isn't fancy, it's basic financial damage control. 27. Adding an authorized user who ruins your utilization. You try helping someone, then your own score takes a hit. Authorized users inherit the account's history on many credit reports. Sometimes the authorized user isn't even spending, just sharing utilization. Lenders pulling credit see the debt and don't ask whose it is. People notice it before a mortgage, when every point matters. The twist is, access isn't the danger, the reported balance is. 28. Removing an authorized user right before a loan. You remove them, and your score changes like a trapdoor. Some people rely on authorized user history to thicken thin files. Right before applying, they get removed to clean up associations. but the positive history can vanish from reports after removal. People in tight timelines panic because reporting updates aren't instant. The twist is, cleaning up can also erase the good parts. Timing matters, because credit history is not a permanent tattoo. 29. Not freezing your credit before big identity theft waves. The damage is done before you even learn your data leaked. After the 2017 Equifax breach, criminals used stolen details widely. A credit freeze blocks new accounts, but many waited too long. By the time they froze, accounts were already opened elsewhere. Cleaning it up required police reports, disputes, and endless patience. The twist is, prevention takes minutes, recovery can take a year. 30. Identity theft, waiting too long to file a dispute. The first sign is small, and that's why it wins. A strange inquiry appears, or a new address shows up. Meanwhile, thieves keep applying, using the same stolen profile repeatedly. Creditors want fast reports, especially within billing dispute windows. Delay means more statements, more accounts, and more paperwork later. Some victims only act when a collector starts calling loudly. By then, the identity trail is colder and messier. The twist is speed matters more than perfect certainty. 31. Student loan autopay discounts lost after one servicer change. A tiny discount disappears, and suddenly payments feel heavier. Federal student loans move servicers as contracts shifted over recent years. Borrowers were transferred from FedLoan to Mohela, Nelmet, or AidVantage. Autopay settings didn't always follow, so borrowers had to re-enroll. Some lost the interest rate discount tied to autopay participation. They noticed when monthly totals increased, even though loans were unchanged. Customer support queues grew, and people waited just to reset. Meanwhile, a missed autopay could trigger late notices during transitions. The twist is, administrative moves can change real money outcomes. 32. Ignoring credit score differences between FICO and Vantage Score. You celebrate a number, then a lender sees a different one. Many free apps show Vantage Score, built by the major bureaus. But most mortgage lenders still rely on FICO models. So a 750 on one screen can be 700 elsewhere. People walk into a dealership expecting prime rates, then get shocked. The finance manager shows a different score and different pricing. Arguments follow, because everyone thinks the other side is lying. The twist is, both scores can be accurate, just different formulas. Knowing which model matters can prevent a very expensive surprise. 33. Chasing new card bonuses while carrying high interest debt. The bonus looks huge until interest eats it alive. In the 2010s, sign-up bonuses became a competitive card battleground. People opened cards, hit spending targets, then kept revolving balances. A couple $100 bonus loses fast against months of high APR. Issuers also watch for churners and can shut accounts unexpectedly. Some travelers saw points clawed back after breaking program rules. Then the user holds multiple inquiries, fees, and shrinking time. The twist is bonuses are rewards for discipline, not rescue. If you're paying interest, the bank is the one winning.